All right.
I'm gonna start letting everyone in.
Yeah, let them in. 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 All right. Hey, guys. Happy Friday. Mute yourself when you come in. Raise your hand if you have questions. We'll get started here in a minute. Woo! I'm tired, man. It's been a long week. Ready to get to the golf course in the 105-degree heat. Is it hot in Phoenix?
Mm-hmm. Yeah,
Freaking
we're
super hot here.
I had someone cancel on me for Saturday, but I'm still gonna.
For golf?
Yeah,
What the hell? Was it too sunny?
Jesse Burrell canceled on me. Says it's too hot.
He did not.
Yeah, he did.
He says that he doesn't bother him.
Yeah, I don't know. Maybe
Whatever.
I don't know.
All right. Well,
Yeah.
if he was listening to us, I'd say he's a loser. But we might that's just take a sound bite and he can go play pickleball in his backyard or something.
I just put in just have everyone. Good morning, everyone. Glad you guys could hop on. Due to the summer and some of the travel stuff that Nick and I have going on, not that we can't, we just like to be a little more structured. So we popped it over onto Friday today. So at least we could get our weekly call in. So we're just letting everybody kind of pop in here. We're on Facebook.
All right,
so
good.
We'll have the replay on there as well.
Yeah, cool. So I am gonna I think we jump into the I'm gonna talk a little bit some of the stuff in the news, want to get into the questions. You know what?
Can you, hey Nick, can you pin both me and you? So
we are pinned.
We are? Okay.
I'm pinned and you're pinned.
I don't see myself.
Pinned.
I only see you when you talk. Oh, spotlight, I meant. Sorry.
Yeah, don't know.
Spotlight you.
Yeah.
There we go. Everybody's spotlighted. Thank you very much.
So, but does that mean the whole group is spotlighted?
No, me and you. Me and you are everyone.
Because it says everyone.
We're just talking to ourselves.
Yeah, I mean, you know what? I tell you what, man, there's so much stuff that they haven't even released yet, like data. They say inflation is like 8%. It's really 15, right? They try to compress and suppress everything. They're the same thing with people that are in default or that are delinquent. I mean, the numbers that I'm seeing, and I'm not going to get into the specific numbers because there's data everywhere, right? So just depends on where you get your fake news from, right? That's what I always say. Who are you going to believe? But here's what I do know: inventory's up. Mortgage applications are way down. Interest rates are up. I don't need to know a whole lot more than that, except that we're literally in the perfect storm for what we do. This is literally right now, today, for the next 6 months to who knows how long. This is what I've been literally waiting for the better part of 10 years. Honestly, I don't want the economy to take a dump. I don't want the stock market to go, crash. I don't know if I can really care about what crypto does because I don't have any of it anyway. Just goes to show you how volatile stuff can be. Guess what's not volatile, Eric? As volatile. Everything's volatile, I guess. Guess what's less volatile? Mortgage note.
Owner-occupant notes that people can afford to make their payment.
Look at the hierarchy of life in general, okay? Let's think about this thing. What's the most important thing to you in your life today? It's your family, most of the people, right? Family's higher priority than a job, right? You want to take care of your family. Now you need a job to take care of your family, but the family's number one, right? Health, fitness, family, whatever it might be. Then having a place to live is probably the second most important thing. Would you agree?
Got your God, your wife, then your family, and then a roof over your head. How about that?
Okay. Here's what I do. What I do know, this is what is higher than. It's higher than a car. All right. Cars are a need or a want, not a need. Housing is a need, not a want. Okay. People will figure out, they'll beg, borrow, and steal to make a payment because they have to have a place to live. And if you're in the right, that's why I don't like doing stuff in high price band stuff. When we talk about ZHVI and the median home price for a zip code, I don't want to be on the far right of that curve, man, because people can stay in that same zip code and go to the other side. Well, if you're at the far left of it or in the middle, there's nowhere else to go. If you're in a median home price house, where are you going to go the other side, right? You can't go any lower. But if you're in a nice place, you live in Scottsdale, right? Or you live in Frisco, Texas, or Plano, or any of these, Orange County, you can downgrade from those places, right? Not that you want to, but you can go into you can leave a $5,000 a month mortgage and go to a $2,000 or $3,000 a month apartment and live. But if you're already in that $2,000 price point, there's not a lot of other places to go. So you make it happen. That's why I love when we write notes to the buyer class, the middle America, the blue collar, they just don't go anywhere. They're not entitled, man. They're not entitled like some of the other ones. But the reason why I bring all this up, because this is where the opportunity is going to be for us to really, really take advantage of it. When we do our master class in a couple of weeks, and we'll talk about it here in a second, for the people that are invited that are part of that, that's what we're going to really, we're going to talk about these kind of things. We're going to talk about what I'm going to do. What we're, you obviously we work this arena together. We do Creative Dealmaker together collectively, but there's things that I do separately than you. You do things separately of me, and because we're at different stages of our lives in a lot of ways. My kids are older. You're still spending a lot of time on weekends and stuff with kids. So you have a different set of responsibilities than I do, just like everybody else that's on this call. So all what I want to be able to do when we do the master class is really say, here's what I've done, why I've done it. Here's what I'm going to do moving forward. Here's why I'm going to do it. And then you guys can all determine whether you like what Nick and Eric, or Nick does or Eric does, and see if it's a fit for what you guys ultimately want to do. I already know the answer of the question that I'm asking. So I'm excited about that class. It's coming up. When is the date on that? Let me just share my screen and see if I can find it real quick, and then we'll get into the questions. I think it's right here.
Basically, you guys, we're gonna take all the information that we created in the master class. Everybody that has taken the master class and had access to that master class is to come in, and we're going to deep dive for 2 days. So it's basically the ultimate action step model, and today what we're doing today. And so with our course, it's the $14.97 course, the master class. If you have access to that, then you're going to get an invite to come in and actually take that and create action steps and we're not going to just talk about we're going to go a little deeper, because obviously the market's changing. Nick and I have different thoughts on where we're at. What I will tell you is we're exactly where we're at right now. Better time in 2004 when I started buying and selling real estate in my first initial deal I ever did. I don't know if anyone's heard the story behind that is, but I started door knocking pre-foreclosures. So it's a little more competitive than it was then, but we have the knowledge and expertise to position ourselves to help a lot of people who may or may not have the opportunity to keep their home, and so get a little more creative. But our model doesn't change. We still create the first and second. We still sell our homes to deserving borrowers. We still do all that stuff. So
yeah. So in the Facebook group, I'm not sure who's on this call that's in the group, who's not in the group. If you're not in the group, go get in the group, because this is where a lot of the information resides. It's where all the resource center is, where you ask your questions, you post them here, all that stuff. I'm not a big fan of Facebook, but it's what most people want to use. So that's why we have it. So the master class, I'm just going to go through it right here real quick. And you can see it all right here. I'm just going to do a real quick recap so you guys know how to get in it, because if you're not in the group already, you need to get in it if you want to be able to participate as we go along. I think we got about 18 to 20 registered right now. I imagine anybody that qualifies will let in. And if that means we got to go 3 days to make sure we get to cover what we'll do that. That's why we're starting it on Thursday and Friday, doing Thursday, Friday. That way it allows us to have the ability to go into another day if we need to. I don't think we will, because I think how we're doing it. Because what we're not going to do in that class is we're not going to teach you how to do what we already have been teaching, the master class. It's going to be more advanced strategies and really how to turn up your business and get deals done. And so if you look at it here, so here are the 3 things that you have to do. One, to be able to attend, you have got to have completed the digital masterclass. Okay. If you haven't seen the digital masterclass, don't know what it is, go to creativedealmaker.com/video. Okay. LV, I'll put it in the chat. It's on the Facebook page as well. Watch the video, follow the prompts. If it seems like it's something that's a good fit for you, do it. If it's not, so what? I don't really care. We're still going to do office hour lives and we're going to still share. But what we're not going to do when we're doing the masterclass is talk about what is a deal or not a deal, or what is a how do I find deals. That we're going to dig deep into it, but we're actually going to apply higher in strategies that get away from the cash now, cash flow, cash later model, because things have changing, but that's not the point of this group. Then second thing you need to do is you need to get the new deal, the deal or no deal modeling spreadsheet, and you need to fill out a deal and you need to submit it. Okay. You need to follow the instruction. There's a video at the top of the page. Follow the instructions, do it the correct way, and submit it. Now, it doesn't matter if this is a real deal or not. Okay. It doesn't have to be a deal that you're trying to buy. You've already done. But what we want to do is we want to break these things down very similar to what we did on the call last week, and really sort of go through. I want to go through the thought process that you guys are using. How did you come up to where you got to this? Why do you think it's worth this? Why do you think you want to exit this way? Why did you pick this market or this neighborhood or this zip code or whatever it might be? And just have a conversation back and forth, and everybody that's on there will get the benefit from that, because you guys are fairly new, or most of you guys are fairly new at doing creative deal structuring. Well, I can tell you who's not new at it, and that's Eric and myself, right? So pick our brains, take advantage of it. Doesn't mean you have to do it the way we're going to do it, but we're going to tell you why we would do it a certain way, and that's the true benefit of it. Then we're also going to have, so if you don't have the updated model, go to cashflowdealmachine.com. You can download it. Okay. Don't click on the link inside the Facebook group, because Facebook doesn't like it when you leave their site. There's the link right there. Use it. Okay. So there's that. Okay. Follow the instructions. We're going to have some special guests in there. We're going to be rolling out. We have a new custom CRM that integrates a lot of the creative deal structuring into the back end in a very automated online version that you might like or may not like. I don't know. I like it, and I'll show you the reason why we like it. And we'll have a couple other special guests on that I think that are understand what we do and can really help us collectively as that. So that's it. Any other, and then just follow the instructions, submit it to support, and go from there. So I don't have anything else on that that we want to add. Let's see here. Let me go ahead and stop the share on that. And I think we want to get Eric, you have anything you want to add on that before we jump into the Q&A?
No, we're gonna dig deeper, and because the whole point of it is you go and you purchase a course. I mean, what we're charging is, I mean, we know our competition and what other people are doing out there, and it's the most affordable thing that I can think of for the value that we're providing. So the challenge is you go through it, but if you don't take the time to take action steps in order to just do one deal, maybe you're a one deal a year person. That's fantastic. It's still providing value, but maybe you want to do one deal a week. And then 4 or 5 years from now, you wake up and you're completely financially free because of your note investing business. So what our whole purpose behind this is you go and you deep dive into each section of the program, the course. You get to actually ask us questions, and we get to go deep dive on where we're at today, right? And then you take action steps and create a success path for you and your family and what you're doing in order to achieve, for us, it's financial freedom through real estate, but using this as a tool in your toolbox. I mean, there's lots of fix and flippers. There's lots of apartment people that we work with. There's lots of hard money lenders. There's a lot of people that do this stuff, but we know that this is another tool in the toolbox, because for me, it's the most passive investment model you can have. There are some limitations in regards to, well, if your note gets paid off, you have to do another deal. Well, guess what? We just do another deal, you know? So the opportunities are endless. Now, the other side of it is where the market's shifting. We're going to start talking about a little bit more creative ways of getting these deals and keeping them in your portfolio for even if the note does get paid off. So that's it. That's all I wanted to say is just we want to create success paths for everyone. That's why we created this course. And obviously we're note buyers. So there's opportunities for us as well.
Yeah, good. Yeah, exactly. So, and we'll talk a little bit more over the next couple of weeks because we got a couple of weeks before that going forward. Okay, couple of questions here. And then what we'll do, if anybody that's on the call that submitted the deal for the masterclass, so that, you know, that's already done everything. If you're on the call and you want to go, if you have any questions regarding the deal, raise your hand, and then Elvia, go find, we can go dig it up and we can pull up the model towards the end of after the question. There's not many questions today, so we'll just go through them, and then if anybody's got a question they want to ask live, we'll bring them on and ask that question, and then we'll probably go into some deal analysis and just if somebody has one they would like to go over, and then we'll be done. All right, so says, I am new to the group and doing my first note deal in Charlotte. Would love to get some feedback from people that have done multiple deals. Okay. So that was from RJ. So yeah, dude, I think the thing is the best thing you can do is utilize the Facebook group. As we continue to grow and grow, we will get more interaction between the group members. I think it's really important that you guys understand that this group is built around collaboration. Okay. The people that are in this group will help you get deals done. Guys, I was just at a private summit of, you know, meeting of the minds, if you will. That was by invite only. It was in Tennessee. And I was talking to a couple of the guys. I mean, I've been doing deals in Texas since 2001. So I've been doing it for over 20 years, primarily in the Dallas area, but I do the entire state. And there was other people from Dallas that do a very similar strategy to what we teach and do, from at least from the acquisition side. And I bet you collectively, the number of people and deals that have been done in Texas since I started doing this is in the thousands. Then I was talking to a couple of guys, and we were having a conversation, and I go, hey, Jared, how many times have we ever crossed paths on doing deals in Texas? And I didn't remember one. He goes, I think there was one. We ran into one, we crossed paths one time. And I go, David, how many times have we done this? Have we crossed paths? And he goes, never. And I go, Leon, how about, have we ever crossed paths? Have you guys crossed paths with anybody in your space? I mean, because what we do is pretty specific. It's pretty niche, right? And no one, of all the thousands of deals that we've done collectively, we never crossed paths. My point is that it's just a big blue ocean out there. You can't, that's why I have no problems talking about what we do and how we do it, because it doesn't matter. There's way too many properties to go by. There's way too many people to help. There's just way too many deals to be done that it doesn't matter. I could teach 1,000 people what I do and how we do it, and it could never impact the way we do our business. It just doesn't, it's just not possible. There's just too many out there. There's just way too many. So collaborate.
Well, like Nick, so I can't tell you when I had a pretty decent sized wholesale business, how many deals in Maricopa County, in the Phoenix market, well, just Arizona in general, how many wholesalers were out there, and you would never run into them. It's getting a little more competitive now, but the coolest thing about wholesaling is people are teaching wholesaling as their primary source of getting deals.
And why is that, Eric? Why do you think that is? I'm just curious, because everybody thinks because I think it's important to ask that question on why wholesaling is so popular and why do so many people do it.
Oh, I just think it's because you can find you can always find a crappy house. Well, you can always find distress either financially or physically with in the housing market. There's always going to be a nasty house or a nasty situation. God forbid now, I mean, divorce is probably higher than it's ever been with COVID. So the opportunities are and I don't want to say it in a positive way because it's unfortunate, but so a lot of people just don't have the resources They don't have the time, they don't have the ability or the knowledge to actually fix and flip a house or do what they're doing, right? So with us, and all these guys are teaching wholesaling, it's such a great resource to find deals. That's like the number one way we find deals right now is through our network, right? And it's and those guys need quick cash. Well, we get quick cash in our business model too, but then we keep long-term passive income. So how many wholesalers that teach this stuff are buying and holding, creating notes now? Most of them, because they know that passive income is the most important part.
Yeah. So that's one step. And then the step two is in doing it the right way. So that's really the reason. That's why we do what we do. So the reason why I think it is because they don't know what they don't know. I mean, they don't know how to be the bank. They don't know they can be the bank. They don't know, how to think like a bank. And we talked about this many times, is that, that's why they choose to be landlords instead of banks. Once you understand the concept of banking and why banks are in the banking business, I don't know how you can argue on a single family level. I'm not talking commercial or multifamily or storage, because those are better plays to own and generate cash flow that way. But in a single family market, based on what we have available to us today, the ability to negotiate, the ability to help people out, there's no, I'll never own a rental intentionally. I might own it short term, but my intent is never to do the BRRRR strategy.
Have you ever had a rental property in a different market virtually, and then find out that your tenant actually used your rental property as a storage facility, but you didn't know because you weren't local and they just kept paying?
What kind of storage facility were they using it for?
They were apparently in the used tire business.
Used tire business.
So now I literally have a used tire business. I took the property back. And now,
does the inventory have any value, Eric?
So this is so cool. Not for me, but for you guys. It's like when you go buy pools of assets and you buy the good with the bad, you get the bad with the good, right? When you go create a note, now could someone, we create a note, create a tire factory in the house? For sure they could, but that's what happens. So now I have 3,000 tires. If anyone in here knows how to what the environmental, if anybody,
I know the answer to that. So do you think are these usable tires? Do you have, is there street value on this?
No, it's a refurbished model. I just found this out, by the way.
I tell you I know exactly what the value of a used tire is. It costs you $3 to dispose of it.
Okay.
I'm just telling you. I'm hoping that you can put these on Facebook Marketplace and make $1 a tire and make $3,000 and go to
so just to start the start of the rehab, it's already cost me $9,000 just to get rid of the damn tires. Is that what you're saying?
$90,000.
Well, no, did I do that wrong? 3 times 3,000 tires. That's 9,000. All right, whatever.
90,000. You're gonna have to cancel your European vacation, I guess.
Anyway, my point is the big note pools and stuff that you can go out. That's why we love note creation from the start to finish, because we know what we're getting into. We know
it's a great point, but this is really, really important, guys. I mean, what Eric, we haven't got to this point, but when you create from the beginning and the beginning, the middle, and the end of the story, it makes all the difference in the world. We know all that, right? And when you're going to keep in something, it's like buying a brand new car. Okay. When you go buy a brand new car, do you believe that you believe that car is going to perform? Is it likely going to perform? Meaning when you get in and you start it, is it going to go? Right? Do you expect any problems with that car when it's brand new and you roll off the lot? No.
Do I expect it to run?
You expect it to run and perform do what as long as you take care of it, right? But what you don't know is when you go buy a used car that's been used for 5 years, you have no idea. It may look good, but doesn't mean it's going to perform. And just because it performs today doesn't mean it's going to perform tomorrow. And that's why when we create these notes, really, really important to have the maintenance records. Okay, I'm just using the analogy, having the service records, having all the history that you need to make this thing as valuable as possible. But more important than that is knowing that you're not going to have problems, because if we talked about this before, when you have a performing note, and this is why it's so important, because in a way even though we're building the notes, we're also holding the notes, because we're going to, most people are going to stay in these deals. But the first lien holder is looking at this stuff and going, this is a 30-year investment, at least on paper. What's a 30-year investment for you in the second lien position? So when I write my notes, I want to make damn sure that I'm not going to have a problem with that borrower sometime in the future. I want to get paid. I want to set it and forget it. And when you take shortcuts and you don't do things the right way, and you don't follow use the transaction coordinator the way we set it up to do, or use the servicing protocol, or the underwriting process, those are the things that you're going to have to contend with in the future, and it's going to cost you money. Somebody was asking the other day in the Facebook group, hey, I closed the deal and they didn't, I don't know if they escrow taxes and insurance correctly, but typically if I close, what's the date today? 9th, 10th, whatever it is of June. If I close a property today, you pay a mortgage in the rears. Rent, you pay in advance. A lot of bills you pay in advance, like electric, you pay in arrears, meaning you use it, then you pay it. You don't do that with rent. You always pay your rent in advance. You pay your July rent the 1st of July, and then you consume it for the month. Mortgages are not the same. They're in arrears, meaning you get to move in and live for the month of July, then you pay the lender. Okay. So typically what happens, they escrow the taxes and insurance for the month, and then you make your first payment one full calendar month later. So if you close it anytime in June, you get the month of July off, and the first payment's due in July and August. Make sense?
Yep.
So
they'll collect for the halfway through, and then
yes, they prorate, right? So it doesn't matter if you close on the 1st of June or the 30th of June, the buyer doesn't make their first payment typically until August. Now, can you change that? Absolutely. That's how most lenders do it. So when somebody wrote the note incorrectly, or I would say, when you can close it today and make the first payment in July. That's not typical and standard. Does it change the value of the note and what it does? It depends. It depends on how it was written. Was it done correctly? I don't know. I didn't see the paperwork, but we don't want to do that. We want to keep best business practices in order, because we want to limit the amount of subjectivity to these deals.
But Nick, going back to that real quick, and then we'll start asking some questions. But
well, these actually are some of the questions. I'm just sort of integrating them, but go ahead.
So my point to all this, it's so important to have, if you go through the academy and then you get to go pick our brain for 2 days, these questions and why you have the right team and the right process and everyone in play. Because have you ever boarded a note? Well, you're probably a bad question. I boarded a note and didn't board it correctly, or they didn't do something correctly, or the note was written incorrectly. And I hired the people to do it, but think about the time it took for me to fix that note. That's why we created this. That's why we created the program. So you can go through the step-by-step processes and have the team in place, so you don't make those mistakes. So you don't have to unwind stuff.
It's not even about making a mistake. It's not even about making a mistake. It's about finding the mistake before you freaking record the damn documents and the buyer walks out of the closing. Because once the buyer signs, you are screwed. Now, there are disclosures there. Again, not everybody does this. If I write it, this is why we say this. Okay. In my closing package, guess what's in there? There's disclosures and says, hey, if we find an error after we did this, guess what? You're required to come back and re-sign documents so we can fix the problem. But guess what happens if you don't do that? You have no recourse. You're screwed, and you hope that you can figure out a way to make it work. That's why it's so really critical, whether you implement your own process or you implement somebody else's that's tried and true, have a system and a process, and make sure you triple check this stuff, because once stuff gets recorded and that deed transfers to that new owner, you lose a lot of control in that process. And the the downside risk is way, way more important than the upside gain.
I think what you're saying is paying the team to do it correctly is that's what we created. So,
well, so the cost for the return is one thing, right? So if it costs you an extra $2,000, okay, let's use $100,000 note. The national average says that we're going to be able to get that. You're going to be able to net and then somewhere between 7 and 10%. So on a $100,000 note, that's an extra $7,000 to $10,000 that you don't have to pay in the form of a discount. Okay. So if it costs you 2 to make an extra 7 to 10, just from a financial perspective, that's money well spent. But it's much, much more important than the financial side of it. It's the quality of the paper side of it, because if you don't do that, okay, and it does get found by a sophisticated note buyer, and then it gets reduced, then it might cost you might be losing an additional 5% on the other side of the equation, because you did something like not escrowing taxes and insurance, or not charging for, or self-servicing, or things like those, or writing a 3.5%, 4% mortgage. Now, hopefully people aren't doing that now, but I just got one the other day. It's like, yeah, it was written like a year ago, and they wrote a 3.5% mortgage on this. They go, well, it's only at a 50% value. Like, it's $150,000 note on a $300,000 property. It's 3.5%.
They're valuing their note on the loan to value, not the cash flow.
So dumb.
Bad.
So dumb.
Now, well, guess what their note's worth? 50% of that.
I know what it's not worth. It's not worth $150,000.
Oh, it's worth half.
Maybe.
Yeah.
Maybe half.
Yep.
So that's why you got to make sure. That's why we talk about APOR plus 6.5. I think somebody had mentioned it in the thing. Let's see if the question's here. I'll get to it. So let's go through these other questions. So it says, what do you think the most important thing is to get right when you create the notes? Well, that's what we just got done talking about for the last 5 minutes, right? It's knowing what you don't know, right? How do you figure out what you don't know? And the only way I can say that is when you do 1,000 notes, you figure it out, right?
Well, the disclosures is really important, because then you can go back and fix it contractually. Hey, Nick,
Yes.
What I wanted to do is Marie had a specific deal she wanted to go through. Can we go through hers first, and then we'll come back?
I mean, there's like 3 or 4 more questions, and then we can go in there,
Okay.
and then we can do that. So does she have a deal in the? Do we have a deal in the folder, Elvia? Do we have a deal in the from Marie's stable?
She might have had a specific question she put in a Facebook group that I responded to.
All right. So here's the question. Here's the question sheet to see if this is the right question. If not, we can figure it out. It says, we are about to purchase a house with the seller holding the note for us.
Yeah.
We intend to sell on owner finance and then sell the first note to eliminate our debt on the property. That sounds like what we teach. Is it best in this case to do an installment sale with our buyers so the deed stays in our name throughout the transaction? Is that the question?
Yeah. Well, oh, we need to unmute her. She's right. She's got her hand up right now.
Yes,
Right.
that is the question.
Yep. Okay.
What part of it? There's other questions with that.
Okay.
Deal.
Well, I'm just going to tell you the way that I do it. So if I so there are 2 separate transactions, when I buy it and then when I sell it, right? So if I'm buying it, then I'm going to buy it and I'm going to put the terms in the deal that best suit what I need to get done. The seller will take advantage of an installment sale if they're selling it to me on terms. When I turn around and sell it, I think this is the question you're asking, do it with our buyer, the stays in our name. Says it's the best in this case to do an installment sale has nothing. I don't believe the installment sale has anything to do with. I don't know this. If you change I guess the question is, and we'll have to find this out, Eric. If we do a contract for deed, if somebody does a contract for deed, does it still constitute an installment sale?
Well, so hold on. I'll give you an example. Marie, so I've purchased I had the seller. So let's just use this as an example. I purchased a house subject to the existing debt. Okay. They sold me the house. We created an exact wrap. Okay.
Did you say, did you do a contract for deed or a mortgage deed of trust with your buyer?
I did a mortgage and deed of trust. So
And why did you do that instead of a contract for deed? Just curious.
well, I'll tell you why. So then because of the, this is in the past, I probably would change it now. But then what I did is I bought it with I purchased it and created an exact wrap on a note deed of trust. Okay. So I took that over. Then I resold it on a contract for deed. The reason I resold it on a contract for deed, I did a 30-year term. All my terms were in line. Everything was great. There was a huge arbitrage between what I bought it for and what I sold it for. And this is what we're going to talk about, I think, with the way you structure this deal. And at the time, this is a few years ago, and I got a pretty big down payment. I think it was like 35,000 or 40,000 down. So in my mind, that buyer that bought it for me, so I put little to no money down. I gave the seller some spread in the cash flow that he had in his note. I gave him some income. He moved to a retirement home, and it basically pays for his cell phone bill and some other things. Okay. So that's the cash flow that he created. And then I was able to go arbitrage that and make probably $800 or $900 a month. Okay. Plus the cash down payment. The reason I did a contract for deed was the reason why a lot of people do it is because the forfeiture is quicker. Okay. But in my mind, because of the amount of money that person put down, I would have to foreclose anyway. So I would not do that anymore. I would just do an exact wrap.
And we don't teach that anyway. And I don't even want to really talk about that in the future because I'm only going to do it one way. And I'm going to do it the way the bank does it. Okay?
Well, that's what.
So my point is this is what I want to make sure that we do is that I don't want to talk in the future about should I do a contract for deed or a deed of trust or a mortgage, because we want to teach it how the bank is, right? So the answer to Marie's question is that I don't really give a rip. Okay. And what I mean by that is I don't really care if the deed doesn't stay in my name. It will never stay in my name.
Yeah.
It'll never, ever stay in my name because I don't need it to stay in my name.
Right.
So I'm going to answer as if I'm transferring the deed to the new buyer, because I could give two rips about having the deed in my name. I don't need it to be in my name because Bank of America
doesn't control with a note. But Marie,
Bank of America doesn't have deeds in their name. They don't do contract for deeds.
So real quick, Marie. So let me just go through this. So this is one of the things that jumped out to me the most. The seller selling you the house on terms, correct?
Correct. And it is free and clear.
Free and clear. Is it 0%?
Yes.
So now you have a note that they're giving you at 0%.
Yes.
So there's a couple things, and it's a good.
Have you already signed and closed this, Marie?
We have not. We're signing the contract sometime this month. We're just waiting for him to get things cleared out. But he asked us the question, how is he protected in this deal?
Because he gets a note and deed of trust.
Because he's the bank. He is the bank. He is the bank of whatever his name is, Bank of Mike.
Okay,
That's
but then when we sell the property to our buyer, how?
So here's what I'm just going to give you my opinion. If anyone ever gives me a 0% loan, I will never, how do I want to say this? I will not sell there's no reason to sell that first lien. You can still create a first and second and do all that cool stuff. Okay. If you want to get some liquidity, maybe get from the second or whatever, or leverage it or partial it or whatever. But that first lien is one of your biggest assets because so not every single deal needs to be a note. Okay. Maybe because you guys
Why not?
Well, I mean, I'm just saying that, but
why wouldn't, what is the negative side of writing the note?
Well, hold on. So I'll give you my opinion. We're going to go back and forth here because this is a really, really good one. So you do create the first and second and keep it. You have first right of refusal. You do the whole thing. You have first right of refusal to buy that first lien too, because that first lien's at 0%. The value, what the value of that is. It's very, very, very low. So once you structure it correctly, 100%, I'm on Nick's page when it comes to creating a note, selling it, but just, you're not going to sell that.
I'm not saying you sell it. Never, but I'm saying you don't change the way you create it.
Right.
Okay.
That's all I'm saying. You still want to create it. You want to create the wrap mortgage the same way, whether you're you're
Right.
planning on selling the first and keeping the second, selling both of the notes, whatever, you still want to create it. That's all I was saying.
Oh,
Try to
100,
do-
100%.
Yeah, because you want to give yourself options because you know what happens? Life happens.
For you
And
and
5 years down the road,
you and the note seller.
you might need to get some cash out of that deal and you might need to go buy a car. You might have to put a kid through college or somebody gets sick. That's why that's what you want to do is create options because I'm telling you right now, we talked about that $27 billion a year seller financing paper. People that wrote those notes did not take any, majority of them did not take any of that stuff into consideration. And guess what they're paying the price for right now? Somebody coming in and buying that stuff. It's no different at that point in time is buying a distressed wholesale property from a distressed seller. It's no different. It's a distressed note. It's still an asset and there's value with it. So,
So
you
real
don't have,
quick, let's like with that. Okay, so I want to just answer the question. So you're gonna go buy this house, and I don't I don't remember the exact numbers. Was it 80,000 or
We
something?
bought it for 80,000. It's a $10,000 down payment. He wanted me to come up, and I did because it's a good deal. It's still a
Yeah.
good deal.
Yep.
And I negotiated 5,000 down up front, and then the other 5,000 is 6 months.
Perfect. So now you have now you owe him 70. Okay.
Yes.
So just let's go, and Nick, back me up with this. Now he's basically Chase Bank. What does Chase Bank get? They get a note with all the terms that tell you the terms, how much, when you pay them, what the interest rate is, all that, and then you get a deed of trust that secures his interest. So someone asked, how does that seller secure his interest? Well, he has a note that you're responsible to pay, and he has a deed of trust securing that property. But with that, there's a no due on sale clause. You're going to put a no due on sale clause because you know you're going to go resell this and arbitrage it. So make sure in the note it has a no due on sale clause in there. So when you do sell it, he's not going to be able to call the note due because then it's, like all the other companies, a private investor versus a bank, they have the no due on sale clause. You want to make sure it's in there in your documents, right? And there's the checklist on exactly how you want to sell, because what you get the seller to do for you is different than what you're going to do when you sell it. You're going to have it in your favor on the buy and on your favor on the sell. Does that make sense?
Right. So when we sell it
Yep.
to our buyer, we do want a due on sale clause
Mm,
in
mm,
our note to them.
Yes. You can have the
Okay.
due on sale. So if they do sell it, if they do transfer the deed or they do quick, like honestly, I don't, Nick might have a different opinion on it. Truly, I don't think he really cares if due on sale or not. I'm kind of 50-50, but if it's in there, you have options, right?
I will always have a due on sale in my wrap mortgages. I
Yeah.
can promise
Yep.
you that.
Yes.
Yeah, you're not going to do because I'm bank and I'm different because what's different between me and Chase is that I care and I'm going to make sure that I put myself in the best position to get paid. Where the bank, they're just too big. They don't have the hell's that? Some guy's rolling something down on the hallway there. Yeah. So if we're talking about this from the standpoint is the best, it says in the best case to do an installment sale with our buyer. So the deed stays in our name. I don't know what that means, but I will just tell you how I do it. Mortgage deed of trust, deed gets transferred over to their name. I'm taking an installment sale for the money that comes in. And that's why, and I'm not going to get into how that works. Talk to your CPA, your financial advisor, whoever that understands installment sales. That's how I do it, period. I sell for $100,000. I'm going to get, and I write a 30-year note. 1/30th of that basically is what my taxable event is each year, or until it's paid in full. If it paid, it could get paid off early. What the seller does on his side, it's up to him. Don't really know. Okay, does that answer your question?
It does. I do have a follow-up on that.
Okay.
So on another one, we actually have three. Well, we signed 2 contracts, and this is the one we're talking about now. We'll be signing soon. So on another one that we have under contract, and it's at the title company, and they're working on closing. We're going to be. It's a cash deal, and it's a hard money loan.
Mhm.
So how does that work then? If he's going to have a due on sale clause in his note, how does that work when we go then to sell to our buyer. Because
Okay.
we need several
So
months.
does
to get that note
Wells
sold.
Fargo have due on sale clauses when you go buy a sub two, when you go buy a property sub two?
Yeah,
What does Wells Fargo do?
nothing.
Okay, so then where's
Well,
the issue? First of all, you're not gonna be in it long enough for them to ever do anything to even go
Okay.
into a default status, okay? That's number one, okay? I'm not saying you shouldn't disclose it. I tell my lenders I'm gonna wrap it and I'm gonna have them paid off in less than 30 days. And if they don't like it, I just tell them I'll just find another lender, okay?
Okay.
That's it. There's nothing against the law with wrapping another underlying mortgage, as long as you disclose it to your buyer, okay? It says they may call the note, okay? Usually.
No, so keyword, when we sell our homes and we have underlying debt, we disclose to our buyer that there is underlying debt. And then we're gonna pay it off. So we disclose everything in the transaction. They don't even know what we're talking about. But our traditional buyers are just so blessed to have a house. They don't care. And we're not harming them because we're gonna take them out with longer term debt or longer term.
Hard money lender is no different than Chase or Bank of America. They just want to get paid. They're still in the first lien position, guys. It doesn't matter if we go wrap it. They're still in the first lien position.
Until they get paid off, they're in the first lien position. They're covered.
They're not changing it. Guess what we can't do? Guess what we can't do with the note that you create? You can't sell that note to a note buyer unless it's in the first lien position. Well, until you pay off that hard money, that note is not worth anything.
And so when let's just say we came in and bought that first lien, you created the first and second, and we come out, buy that first lien, our money is going to pay off the hard money lender. And then now we're in the first, now we're in senior position.
Look, I'm not saying if you feel more comfortable telling your lender what you're doing and doing a transfer of collateral and an allonge and all that crap for 2 weeks, go ahead and do it. There's nothing wrong with it. A sophisticated lender will know what that means and how that works.
So Nick and I have been doing it this way for a long, long time because we do the right thing. There's no problems because we're
going to pay it off. That hard money lender is going to get paid off as quickly as I physically can do it, period, because he's expensive.
Yes.
I don't want him in there. That's why we do this model and we take that. So we're just doing one. They're closing it today. Okay. Somebody goes, hey, when can we close the note? He wants to close it and pay off his underlying debt. I go, well, we got to close it today. Then we got to record the documents. We got to wait for the recordings to come back. And then from there, we can probably get it closed and funded in a couple of days. So I said, give it till next Friday. And then from there, we will close it. And, we're going to say we're giving them $100,000 and the hard money is 80. Well, $80,000 gets paid directly to the hard money lender. The other 20 will go to the note.
And then they release their right to the property, and then we're good.
We re-record it and go from there. Yeah.
Yep.
It's no different than any other closings.
Here's the best part. When you're going direct to seller and you're getting the seller to create notes, this is a dream time. Going back to 2004 when I started this, we were taking over variable paper, notes that were variable note on the subject to side, variable paper. We have people that have so much free and clear debt right now that when we come in and offer the value that we're providing them in income, it's just it's a dream time. And then we know we have the exit to provide homeownership for people that need they're fully bankable, but not from a traditional bank side, that we have this solution down the line. Like, think about all the people you're affecting in a positive way. I mean, even from the hard money lender all the way to the end buyer, to the whole, it's fantastic. It's just,
great. We can talk about the conceptual aspect of it, but at the end of the day, here's what I will tell you. What we do is perfectly legal. And our intent is to get people paid and disclose. Okay. So it's no different than that. I would say what you got to be careful of is I think it's really, really important that if we're going to do something with that note on the back end, you have to follow what state are these in anyway?
Pennsylvania.
Great. My third least favorite state.
Yeah, it's not very investor friendly, but hey.
But it doesn't really matter. Is that the hard money one or the seller finance? Or both?
Both. They're all in Pennsylvania.
Yeah.
That's where we live.
There's quality.
It doesn't mean you have to go. Doesn't mean you have to go do it. And just because That's the biggest problem that I see people making is they do stuff in their backyard because it's convenient. Doesn't mean you should be doing it. Okay. I'm fortunate enough to be in Texas and I know the model that works best for my state. If I was in Pennsylvania, I may have a whole different opinion on how I do.
I own and I have notes in Pennsylvania, so you'll be fine.
Yeah.
There's
How
lots of
those working out for you?
they're great.
Is that where the tire warehouse is? What state is
No,
that?
it's not. Hey, I will tell you the big, if the guy wasn't dying, which I found out he probably wasn't dying because he didn't want me to know he's used a warehouse. If I didn't know, if he was just paying me, I would have I wouldn't have cared because I was in such a good position. I would have just keep collecting the income on it. I didn't care. I mean, I had security to the property. So if he uses a tire warehouse or not, I honestly didn't care. I was making good money. He was just dying and had to move. And so then
It's like anything else. It's not a problem. It's not a problem until it's a problem, right?
Yep.
Right.
Not a problem until it's a problem. So we just want to put ourselves in the best position to succeed
Yes.
and get that thing. So I'm not saying you can't do seller financing in Pennsylvania.
Right.
All I'm saying is that I would probably understand. I would want to know what the note values are in those states. How long does it take to get that property back? And is it because I think Pennsylvania is a judicial state.
It
is it
is.
not?
It is.
Not help us all. But,
Yeah.
but you know
I
what you
know.
have to do is you just got to buy the deal better, right?
Mhm.
You just got to do a better job of acquiring it. And if it doesn't fit the model,
And
Like-
underwriting the buyer correctly, because then you know they're a qualified buyer too. So if they're gonna pay, it doesn't really matter where it is.
it doesn't matter. It could be in the moon, right? The seller financing is a whole different beast, right? Because
The default factor is what you got to protect yourself from. That's all.
yeah.
Mhm.
So Marie,
right.
Marie, did we answer? Did you have one more? You said you had one more, or was that it?
I think that might be it. I did throw a couple questions in the
'Cause I
chat.
wanted to get to Kevin because he's had his hand up.
Yeah, I
right?
want to get
Yep.
so let me do two more questions. Then we're going to go to Kevin and Jonathan's. Okay, because I want to make sure we cover these. All right. Next question is, so with the current interest rates for standard loan products now, should we also be adjusting our interest rates for seller financing? I did make a comment in there, and the answer is they're totally independent of each other. They have the current market for traditional rates has no correlation to what we charge our buyers. What matters is it's really more of a relationship to what the market will bear and what other investment strategies with similar risk pay. Okay. Because we're selling a note, let's just say we write it at 9.5%. Okay. Selling a first lien position, 9.5% with a 75% LTV. What is a similar asset in return that's securitized by real estate? Well, there isn't any, first of all, right? You have to go to maybe a bond or something like that, or a CD. They're,
Underwritten the way we do it.
yeah. So the
It says-
question is,
I don't
what's
think
the
there is.
market? What will the market bear for that asset? From what I can see right now, with the rates have gone up significantly. Now, if they go to 7 or 8%, that may change. But what we have to be able to do is we have to write these in accordance to Dodd-Frank, right? They say that we can write a mortgage to keep it qualified and conforming at APR plus 6.5%. Well, APR is an average prime offer rate. Think of it like LIBOR or something like that. And I don't know what it is now because I don't do the underwriting. That's what underwriters get paid to do. Otherwise, I got to know that number too. But I know my underwriters that we have vetted. That's the first thing they do. They go look at it and they say, APR is 4%. Okay. Well, that means I can write 4 plus 6.5. I can write a note at 10.5% if I choose to and still have it meet the criteria. I don't want to go to 3%. I want to go higher. Now,
Yeah.
will the market bear 10.5% in the market? Well, it will if the regular rates go to 8, right? Well, surely can do that, right? They go back to 2, which is not going to happen. I probably have a harder time charging 10.5, but I can still do that. The other thing that people don't realize is that that's when there's no underlying debt. Well, guess what I have when I buy it subject to, or I wrap a hard money loan, the underlying debt. I can actually add more points to that note. So instead of being 6.5, I think I can actually add 2 more points. It's either 1 or 2. I don't have to normally do it, So now I I can write a 12% mortgage, 12.5% mortgage. Oh, guess what else I can do? On the second lien, 100% of the time, because it's junior to the first anyway, I can add it to that too. So I can write 12% mortgages and still have them qualified and conforming in accordance to what Dodd-Frank says. That's why knowing what that 1,800-page document says is extremely valuable. Ask me if I read every page of it, Eric.
No, but
No.
our underwriters have.
Guess who has read it? The attorneys,
Yeah.
the servicers, the underwriters. Okay. I don't need it. I just need to have the right people that understand what that says and what it represents. All right. So last question here. I think I answered it. So answers the current rate. All right. So I think that answers all of that real quick. So let's go ahead. Kevin Smith, thanks for being patient. Go ahead and unmute yourself, ask your question. And then the next question will go to Jonathan. And if we have any other questions left, we can be done with that. So we'll check the chat as well. What's up, Kevin?
Hey, how everybody doing?
Hey,
Good.
Kevin.
I had two questions. You kind of answered the first one in regards to the deal. I have one going through underwriting with constant close, and it's going through the RMLO process right now.
And who are they using for the RMLO? Because we have 3 or 4 of them. What state is this in, by the way? What state?
South Carolina.
Okay.
I
Okay.
think it's Ross is his name.
Well, it used to be called the underwriter. It used to be what was Ross's last name? Oh, probably Mark. Oh, it's probably Mark Ross with Good Services. Okay.
Right. Yeah, that's what it is. That's
yeah,
what it is.
They're out of Tucson. Yeah. Okay. They're fine. Good.
Yeah. So I guess the actual that's supposed to be closing next week, and then because I sent you an email regarding like the underwriting using the template, and just to make sure everything is good in terms
Well,
of
look, that's what you pay. That's what you're paying Constant Close to do, right? So they're going to do a much better job of vetting the process than I ever will. Okay. First of all, I don't know South Carolina. I don't know all the idiosyncrasies. I don't know what the usury laws are. I don't know any of that stuff. They do, or they can look it up. That's why you're paying them the money to make sure everything's in accordance to what needs to be done. So, I mean, I could surely look it up. I'm sure I can figure it out, but that's what they're doing. That's what you're paying them for. So let's go ahead. So this is on the buy. So how did you acquire this property? Let's talk about that for a second.
Cash.
You paid cash. Yeah. Okay. So here's my question.
But no, how did you acquire it? Like, how did you find the buyer, the seller?
Well, let's wait. Let's start at the beginning. Okay. I'm getting that point. So you bought this with cash, correct?
Yes.
Okay. Did you lien the property?
Say that again.
Did you lien the property when you bought it?
No.
Okay.
I don't.
So no. I would say that is a huge mistake. Okay. And here's the reason why. You always want to lien your properties, or I'm going to say you can do whatever you want. Okay. I'm going to be careful not to put words in other people's mouth. I always lien my properties.
When if you pay cash, Nick.
First of all, I would never pay cash. First of all, I would never pay cash. Second of all, if I did pay cash, I would never not lien my property. Okay. Here's the reason why. Because you get clear title when you buy it. What's stopping somebody right now to go into your property and putting a lien on that property? What's stopping anybody from attaching a lien? Okay. Think about that. Okay. Doesn't matter what the lien is for. Doesn't matter if it's legit or not. Guess what has to happen before you can close that property to your buyer? The cloud on title has to be fixed, right? So so I always go in. That's why I use lenders, okay? Because guess what a lender is going to do? Lien the property.
They get a lender's policy to protect them from if another lien pops in the day after, they can go foreclose and get their money back.
But you want to lien it, and I would lien it for more than what it's worth, because I want to put my position so that I'm protected in the first lien position if any shit goes sideways, man. It's just that simple. These are just part of that best business practices. Not saying you can't go buy it with cash, because you can, but you can still lien the property, right? So that's something, there again, a good title company would have told you to do that, honestly. Okay. But there again, just because they're a title company, or just because they're an attorney, because whatever, doesn't mean they understand or think of it that way. So be really, really careful when buying anything without having a lien on it that protects
Okay.
your investment, not somebody else's. Okay. So that's the number one. So now you're getting ready to sell it now. So you found your buyer. How'd you find the buyer? Let's talk about how'd you find the house first? I just want to sort of go through this because I think people are
Right.
always go, I can't find deals. I can't find buyers. Can't make any money. Obviously, that's not the case, at least based on what you're telling us. So how did you find this property?
I had my VA doing the cold calling,
Okay.
and the seller actually, the house that I purchased was not the actual house that we called about. The
Okay.
house that we
Good.
called about, he was actually doing a refinance on that house. And he said, I have another property that I'd like to sell you if you're interested. And so
Okay.
we end up buying this one.
So you paid cash for it. What was the condition of the house? Did you do any repairs on it, or are you selling it as is?
Just selling it as is.
Okay. Was it lived in before you bought it?
Yeah, he had a tenant in the property. The tenant moved out right around the time he was expressing interest for me
Okay.
to purchase it.
Okay, good. So now you found that. So you bought the house, and now you bought it and you closed it. Okay.
Right.
Now you're gonna go find your wrap buyer or your owner finance buyer.
Right.
How
And-
did you find the buyer? How long did it take?
I found the buyer through, I listed it on Facebook Marketplace. I got a ton of leads from that. And I also sent out some emails to realtors.
So
in South
Kevin, so
Carolina.
let's talk about that for a second. When you say you got a ton of leads on it, try to be a little bit more specific. Like, how long did it take before you started getting leads coming in? What were the leads like? How many did you have? Just give us a little bit of a visualization of what this looks like. Because I haven't talked to you. I don't know anything about this deal.
Right. I posted on Facebook Marketplace probably that night, let's say a Friday night at like 11 p.m. By the
Okay.
next morning, I had probably at least 25 already interested in my inbox.
What did
Now,
the ad say? What did the ad say?
Stop renting, owner finance available, no bank needed, something along those lines.
Okay. So you got 25 people. That was just in less
Just the
than
first
24
night,
Just the first
just the
night.
first 24 hours.
How many
And I at least
collectively do you think you had come in so far?
Oh.
Just ballpark.
Ballpark at least about 300 minimum.
300. Great.
And you have,
A lot of
how
them
many
were-
properties you have?
Just one.
Okay, just curious. So
And so,
there's
yeah, a lot of them were like tire kickers,
Yep.
but yeah, you filtered out a lot of them. I learned to filter them out a lot by just
Right.
having a
And that's all part
template
of your process and
response.
system on how you're doing it.
Right.
But the point is the demand is far greater than the supply.
Right.
So that's everywhere, man. It doesn't make a difference if it's in South Carolina,
mean,
Iowa,
but,
Texas, it
yeah.
makes a difference.
Yeah, but Kevin, so what you did is that one house could technically be a year's worth of work by providing homes for the people that you couldn't provide a home for, that qualify.
Right.
So now
Yeah.
you gather them. I mean, that's exactly what Nick and I do. Whenever you have a property, you just gather. Now you have people with down payment money where they want to be. Your gift is you're a deal guy. You know how to go find deals. You have a system and process to go find deals. Once you get that deal, you already have it sold to an end buyer for seller finance, which is cool. Anyway, so go ahead.
Yeah, so now you got a whole buyer's list if you want to go look for another property, or because I can tell you something about this also. What town was this in? Where this property is?
Columbia, South Carolina.
So it's in Columbia, South Carolina, right smack in the middle of South Carolina. I can promise you, you can go find a house in, let's see, you can go to Sumter, you can go to freaking Aiken, you could probably go down south, you can go to, there's a lot of stuff that's probably within you can go up the Rock Hill. There's probably stuff within an hour of Columbia that people will go to if you had something that's in that list, if you had something that was available with seller financing, because that's the only option they have, right? So
You're giving them a 30-year place to live, not a 1-year rental.
they're
So
not,
they'll
they'll move.
they'll follow you.
Yes, they very well could.
Yes.
So just because they were thinking Columbia was where they went to Columbia because that's where the deal was, right? Well, what if the deal ends up in Rock Hill, right? What's it Rock Hill from Columbia? 45 minutes? Hour?
I have no clue.
It's right on the border. Doesn't matter. They'll go do that. Because I've seen it happen before. So anyway, so you found your buyer, and then when you were negotiating this deal for the end of the buyer, you said you had about 300. Did you narrow? How did you decide who the buyer was going to be? Because I'm assuming you had more than one qualified buyer for this. Is that correct?
Right. So what I did was I had someone in my network go put a lockbox on the door, and I
Okay.
told them that if you're interested, we can schedule a showing, and you go look at it, and then if it's something that you like, then let me know. Then we'll move forward.
Okay.
The
So how
house
many
needed
people
some
actually
little
did?
repairs in the front.
How many people actually did that, do you think?
I say about 30 some odd, somewhere around that
Okay.
ballpark.
And how many actual offers did you get to actually that you could have actually sold this house to, do you think?
Out of that 30, I would say about 10.
So 10. You only need one, right?
Right.
So then you took those 10 and you looked and see what was the best deal for you, who was
Right.
probably the best buyer, the best opportunity to write the best note. And then now you're in the underwriting process.
Right.
And so on. So did you get, just curious, so you did this, and then so now you're going to go close it. Now you're going to go through underwriting and do all that stuff. And then you're going to and then did you put this in the model, and are you writing a first and a second lien on this and planning on exiting out on the first?
Yes.
What
Okay.
what are the numbers on it?
Okay. I posted this in the group a while back. I bought it for 18. I'm selling it for 70. I have the first lien for, I think it's 49, and then the remaining on the second lien.
And how much
Why, I'm just curious, how did you come up with 49? I don't really care about the 70 because they agreed to the price. It probably doesn't matter. I don't really care that much about that, but I'm curious on how you came up with the ratio. How much down payment did you get?
Because, and this is another little caveat about it, because the property isn't in the best desirable location, that shaved off a couple of the interested people who wanted it, who are more qualified, but just the area,
Okay.
they weren't too specific.
So you
about.
sold it for 70. How much down payment did you get?
Believe it's 8.
8. Okay. So 70 minus 8 is 69, 49. So 49 first, 20 second, 8 down, give or take. Okay.
Right.
So my question is, how did you come up? The down payment is the fixed part of this, right? But the first and the second lien are variables. You could have wrote a $30,000 first and a $35,000 second, or whatever the number is. How did you come up with 49 and 20? That's the no, it's 49. What was it? 49.
Yeah, 49. 49.
Nick, the spreadsheet's in the chat if you click on it, I think.
Do I have the spread? No, let me see. Is this the one you modeled?
I'm gonna
I emailed it to you.
It
I
was
think
it.
we have it. Let me see if I have it in my.
Here, I just put it in the
1204,
chat.
right?
I got it right here.
1204 Cactus Avenue.
Yeah,
Is that the
that's
one?
it. That's it.
Yeah,
Nick,
so
let me
that's the
pull
one
it
I
up.
sent it.
It's in your chat, Nick. I just put it
Yeah.
in the chat.
All right, let me just pull this up, because this is important because look, you've done 90% of it, but look, now it's to the point that we need to figure out how to maximize the profitability of these deals. And it's different for everybody. And I think the question is, let me pull this up, and
Sure.
I'm going to walk through this. Give me 1 second to share.
And
the
I think
screen.
that has a link to the pictures in there as well.
Yeah, I'm going to show it right now. So I'm going to share this.
Right.
Okay. Can you guys see my screen, the model?
That's
Yep.
just blank.
Is this the right one?
That's the address, but why is it blank?
No, scroll down, Nick, scroll down to the tab.
I gotta move this.
Oh,
screen.
yeah, the tab. It's
The
next
tab,
tab.
if you hit the tab, it's there.
Yeah. Yeah, I gotta go here. Okay, here it is. Okay. Give me 1 second. Okay, so here we go. So got this all in here. This is all good. I'm not gonna verify any of this stuff. This is all fine, looks good. I want to see, this is what I want to see right here. So you wrote so first thing I see, this is probably not gonna sell for 94%, especially on a $100,000 less house. So I would
Okay.
probably conservatively, because when I model, I want to be conservative in my model. And if it
Right.
overperforms, great. Okay. So I'm going to set this at probably 88%. Okay. To
Okay.
see what it does. Okay. So here it shows that you have a first lien at 52,000, a second lien at 11.5, and cash down at 6. Okay. Are those the
Yeah.
numbers?
Yeah, that's it.
Let's
That's it.
assume these
That's it.
numbers are right. If
Right.
they change, they change. But here's what my question is. Okay. Then I'm going to go down here and I'm going to see, these are the next numbers I want to look at. The cash now, the cash flow, and the profit per day. I like all of these. Okay. So my question to you is, what's the most important thing to you specifically now into this deal? Do you want or need $23,000 in cash? That's my first question. Or do you want more in the form of the note? Because you're trading cash, you're taking cash now in lieu of cash flow, which is basically the second lien on here. Okay.
Right.
So did you solve it that way? Or did you just sort of put the numbers in and see whatever it said you were fine with?
I actually put it that way because of the next deal that I wanted to talk to you guys about,
Okay.
which has a higher cash flow
Okay.
component.
So what we want to do in this situation here, okay, is that let's just say this was my deal. I don't necessarily want $23,000 cash. Maybe I only want $10,000 cash. Okay. So I would come up here and I would change this note ratio and I would lower it, right? When I lower the note ratio, it's going to make my second lien go up. So right now, the second lien, which is right here, is 11,500. I'm going to change this to 65%. Okay. Now my cash goes to 17.2. My second lien goes up to 18.5. Well, I still can go a little lower. So let's just go to 60. Okay. I'm going to go down to 55. Okay. Close enough. So now what I've done is I still have some cash in the deal, which is $11,000. My cash flow went up because now I'm at $233 a month instead of, what was it, like $90 or something like that? Okay. So I still can generate the cash now. I can still generate cash flow, which is this 233, and my cash later is still going to be good because I'm going to have a higher second lien. That's how you use the figure out where you want to be. What you got to be careful of is you don't want this ever to be above 75. You can't come in here and put it at 80, because when you put it at 80, then
You'll get beat up on the discount.
Then this is going to cost you. You might only get 84% now. Okay. Well, then the net effect of that is like, well, shit, I might as well why discount the note when you can keep it and get it paid later because it's a second lien? See what I'm saying? Because guess what doesn't get discounted? The cash and the second lien. So when you're discounting this and you're at an 80 and you're at 65% and you're at an 88% note ratio, you're only discounting it a little bit based on the lien value. Okay. Not the sales price. Somebody goes, well, that's a big discount. I go, well, first of all, the note's not seasoned. Okay. You're asking somebody to buy a 30-year note based on your ability to underwrite that buyer that's never performed or made one payment.
And
okay?
one of the questions is, with only 6,000 down, what's their credit look like? So there's a couple different things that.
Well, those are great questions, but let me tell you what trumps that. It doesn't make that big of a difference because you're only writing a 65% first lien at an 80% note value. Okay. The note buyer's going, well, you know what? I'm only at risk $45,000. Okay. Actually, he's only at risk $40,000 because of the discount. And he's in the first lien position. And how much is the property worth? 70,000.
Yeah.
Well,
So
what is it really worth? Is it really worth 70,000 because you paid 17 for it?
No, the reason that, and it's a long story, but the reason why he sold it to me for 18 is because he had a home equity line of credit on it years back, and the bank sold that note to another bank and to another bank, and it ended up at US Bank, but US Bank had no record of the lien. but
It's
yet they
released.
still had the lien on the property. So he just wanted to get rid of it. So he just wanted to get it off his name. And I was like, okay, I'll take care of it. Because he had somebody already wanted to buy it, but they couldn't deal with it. So they ended up walking away from the deal. And so I got the attorney to kind of follow through with it and reach out to the bank and get them to release the lien.
But my point is that when you write a 65% first lien and you're discounting it to 88%, from a note buyer's perspective, he's only investing 40, the note buyer, when we exit out of this, right? He's only paying $40,000 against a $70,000 house. Let me just say it's only worth 55,000 or 60,000. He's still in a desirable position to buy, because that's what he's going to look at. He's going to look at it, see if the value's there. You know, this might turn out to be, you know what? I'm only going to give you 85%. Okay. That's why we need to know this stuff up front as best as we can. So when we go to model it conservatively, we're not caught off guard, because the last thing we want this number down here to do is turn into a negative, because that means you're coming out of pocket to do that transaction. Doesn't mean you're losing the money. It just means you're getting a bigger note. So let's just say that, for example, I'm just going to change this to 60 and 80 and see if I can make this negative. Still can't do it. I mean, there's so much in here, right?
You bought it right.
I have a second deal that where that number is negative, but the seller, I want to
The
mix
point
up.
is, even if you wrote a 50% first lien and give them a discount on the 70, you're still at $1,700 and you're still at a $29,000 second. Still a smoking deal. Okay.
Right.
So you're not, this is it. So anyway, that's how. Now, is this other one, you don't have the other deal in this model, right?
No, I don't actually. But it's a deal. I can give you the address because it has great pictures online.
So going back to this one before we wrap this one up, okay? And we might want to save the other one to later, because we're already into this. I want to make sure we get to the other question. So I have to go back and change all this back to where you had it. Give me a second. I think that's it right there. So the one thing I would say on this I would put this at 88%. And in all honesty, based on this price point and probably the repairs, I would probably just conservatively put in here 84%. If we get 88%, cool.
But Nick, you can put it whatever you want, but you might want to only expect the 84%.
Well, that's my point. That's we want to model it.
So if someone does offer you 84 and you're like, well, crap, but you're still making money.
Yeah. Yeah, because you could probably go find a private note buyer if you wanted to go looking for them and sell it to them at par.
Yeah.
You know, no one says you got to go sell this right away, but you got cash in it. So, you know, the main thing you want to do is get your cash back out as soon as possible so you can reinvest it into something else. So I'm just going to leave this in here. That way we have it. That's it. So you got anything? I want to get to these rest of these questions in the chat. Kevin, you got any other questions before we let you go?
Yeah, quick question about my other deal. I use the method where you say grab a hard money loan, but the seller is willing to seller finance to me the remaining portion. So if the purchase price is $775, he's willing to finance like $245.
So you're gonna get a $500,000 hard money loan. He's gonna carry the difference. Okay.
Right.
Where is this house located?
Orlando, like 10 miles from Disney World.
Okay.
Yeah, I mean, here's my position.
What's your exit on that?
That's the thing. I was thinking about trying to wrap it or do this route and split it first lien, second lien, and sell the first lien. But that one is more, I would say, complex because I'm not too sure. That's why I wanted to ask you guys about it. I should have led with that one because that one is a lot more.
I'll put it in the
complex
thing
than
and then
this.
send it over. But here's my personal position, and Eric, you give me your personal position
Sure.
on it. Where we are right now in the market, I'm not freaking borrowing money for anything, and until I know that I have the exit. Okay, I'm going to solve the exit before I commit to anything on the front side. There's too much uncertainty in the market right now. Here's the thing: it's a buyer's market now. Whether wholesalers or sellers believe it, it's changed.
Right.
So I am that, and it's only going to get more of a buyer. So I have to be careful if it's a buyer's market on the exit, which I'm fine with. I just need to know what my answer is going to be on it. So
You're not gonna go on Craig, I'm not gonna say you won't, but you're not gonna go put this on for $1 million on Facebook Marketplace.
Oh,
and
no,
get-
I was
put
I was
200.
you
basically thinking
can, there's
about,
buyers on there too for that. That's
No,
not my point.
I know.
What I'm not going to do is take it down and then hope I can find my buyer that meets what I want, because I don't have that control. But I can get it, I can contract it, put it under contract, and then go see if I can find my buyer
100%.
before I close. Treat it more like a
Right.
wholesale transaction, right? How a wholesaler would do it. Unless it's a smoking deal. And now, why can't you just get the seller to carry it all right now, right? Can you not do that?
the hard part about it is because it was a pre-foreclosure deal, but he tried to put it on the market and he has a realtor. So it's like I have to negotiate through the realtor and he relayed the message. So
So
it's
you
not
found
really
that
getting
deal.
relayed.
The people always ask, where'd you find your deal? That was off the MLS.
No, I reached out to the homeowner, but he forwarded me to his realtor because he has a
Oh, okay.
realtor.
Okay,
So
well,
everything I had to do had to go through him.
last time I checked, realtors don't get paid if you don't close the deal. So,
Exactly.
you know,
They
here's the
want,
bottom
they
line.
want you to buy
You
that.
control the hammer. You can't give up control of the hammer. You're telling them what the deal is going to be. You don't ever, let's say, I'm going to tell you what to do. I never make an offer to a seller. I make them give me the offer. And I say yes or no to what the offer is. I control the hammer. I got the checkbook. They don't. I'm not the one that needs to close this house, because if they don't like my deal, guess what? I'm going to go find somebody else that does like it. I could give two rips about that particular house that I'm looking to buy. Because guess what? Out of the 1,000 transactions I've done, guess what? I've never done. Lived in any of those houses. Never once lived in any of them. I'd say 90% of them never even seen. So what do I give a rip? I don't care. It either works or it doesn't work.
But
And
you're
if it's
also,
easy-
you're also looking at just a high priced property. You know,
I think it's what's the ZHVI in that zip code? Did you run that?
I did. It's about like 564, if I'm not mistaken.
I mean,
So, yeah,
it was
the
a
house-
750.
775.
Yeah, I mean, just from what you told me, I don't know that there's so many easier deal. There's a couple things I don't like going. Now, if the seller owned it and he was carrying it back, like Maria's deal, I'd be all over that. Okay.
Oh, I would have
I'd
kept it if it
figure
was
that out.
that, if I had that deal.
But that's not the situation. So you're not
Right.
gonna, that's not gonna work. I mean,
It might work. What if he's got a 2% 30-year fixed loan on that first lien? And you could somehow get it reinstated and then go create a wrap around it. You're still above, well, you're still in that above median home price. Maybe not in Orlando, but I don't know. I don't know. I don't know if I like that deal or not, just as a price point.
Yeah, that was my issue.
I don't have enough.
because-
I don't have enough data, but I would probably, if I liked the property and I thought I could exit it, I would probably just negotiate the acquisition a little bit differently.
Yeah.
But now it's the buyer's market, guys. We don't have to be so damn aggressive any longer on the seller, dealing with sellers, because guess what's happening right now. Okay, and then we're gonna wrap this up in a few minutes here. Interest rates have gone up. We talked about this. I don't remember where the affordability index, or the buying power that a person has. In January, $3,500 payment could buy you a house worth $805,000. Okay, in January, before rates started going up. So you could have a P&I payment, principal and interest payment, of $3,500, and with that control an $805,000 house. Right now, today, as of the middle of May, if you only could afford $3,500 for principal and interest payment, you could only buy a house worth $660,000. Okay, think about that for a second. 6 months ago, $805,000. Today, $650,000, give or take. All right. What happened to all those people that were looking at a $700,000 house? Well, they can't afford it now. That's why inventory is going up. That's why we're at a national average of a 10-year high. Now, I don't put a lot of faith or credit in that, because hell, anything is higher. Anything that it was is going to be a 10-year high now. You had 2 days you had 2 days average on market, and now it goes to 22 days. That's still low days on market, but it's at a 10-year high. I don't know, really if it makes that much different, but eventually we're going to get to 4 and 5 and 6 months worth of inventory. And I don't want to, then you're going to have to just figure out a better way to negotiate with sellers. You have to get better deals on the acquisition. So like I'm looking at 70% numbers right now instead of 75%. We use that 75%, calculation number. I'm down to 70 and I'm probably going to go to 67 and 68. I'm going to keep reducing it because I don't need to pay that much anymore.
But Nick, in your market where you're focusing on, where we're buying in Texas, you already know the number. So you're just, when we have our team looking at properties and looking at wholesale deals, we're just offering 10 grand less to the wholesalers and having them.
I'm just starting there. I don't care. Because here's where we're at right now in the market. We got about I don't know how long it's going to take, but here's what I do know. Wholesalers and sellers are still living in the past. Okay. They either acquired it or they started listing it, and they have the mentality that it's an Uber seller's market. Reality has not caught up with these guys yet. Okay. It hasn't caught up. Okay. When it catches up and they start negotiating under the current conditions, that's going to make things a lot easier. So we got a little bit of a transition period right now where reality hasn't set in with some of these sellers yet, whether it be the actual homeowner or a wholesaler, but that'll change. It won't last very long. It won't.
The other thing is the hedge funds are typically not buying the type of properties that we are. We're buying different properties.
So that's where I was going with this. As the inventory goes up, buyers can be more picky. But here's what's happening, and what's going to happen is that all these HGTV buyers or fix and flop that, or all these real estate investors, how good is the BRRRR strategy right now?
Not when rates are at 7.
I just showed you the affordability index or the buying power. Okay, so now if rates go up 2%, if that's the same thing holds true, and you're an investor and your payment just went up 30% on the same price, can you raise your rents equal to make that work? Probably not. Okay. So you're going to be doing it for less deals. So what's going to happen? Less people are going to be buying and fixing and holding. Some people aren't going to be able to afford the increase in that long-term debt, because now when they can go borrow long-term debt at 3 or 4 or 5%, and now it's 7 or 8, it changes if they can do the deal or not. So anyway, that's what's happening.
It's important to ask every seller, when you're direct to seller, what their current rate is and what their term is on their current note. It's so important.
Well, I would think so. Right. So
hey,
right,
let's
good.
Thanks, Kevin. Let's
yeah,
please,
thanks,
if you have
Kevin.
any more questions, put it in the Facebook group and we'll try to answer them and on other calls. Or
All right. So so here's what we're gonna do. Let's clear the questions in the Facebook group. I mean, in the Zoom chat there.
Jonathan's had his hand raised.
And then I'm going to go to Jonathan, and then we're done. Okay. So Jonathan, hang tight. I just want to make sure, because I want to stay on topic if anybody had questions. So I'm just going to work it from the backwards. Let's see here if there's any. Let's see. Would you want? I think there's a couple questions regarding down payment. Okay. Like they thought the down payment was too low.
No, he asked this is $6,000 down payment. Make sure there's far greater level of
here's why that doesn't. The better question is, what is the borrower's propensity to pay? Right?
Yeah.
Did Kevin come in and go, I only want $6,000? Did Kevin ask for 20 when he started it, or did he only ask for 6? Here's the other thing we don't know: how much work needs to be done on this house, right? How move-in ready is it? Is six? It's only a $70,000 house. Okay. Would I have liked a little bit more? Yeah, maybe, but there's other factors. How good is this borrower? Does he have a good job? Is he going to be able to afford? What's the affordability for him on this payment? I mean, it's not $600. I mean, $6,000 is still substantial. I'm not, for me personally, I'm probably okay with that based on the numbers that I saw. Now, how you hedge against that, you have to write a smaller first lien, because a note buyer is going to look at it and go, you only got $6,000 down, and you want to charge me, you want to write a 75% first lien and you're expecting 90% on it, I ain't doing it, right? That's what's going to happen. But if you show that note buyer that you're in a second position and you're taking all the risk in that because you didn't get it there, and you can put the note buyer in a very is in a more desirable risk-free position, you're going to get the more bang for the buck. So the only thing I would do differently there is I would have said,
And the mortgage payment is $600 a month plus tax and insurance. So he's putting up a pretty substantial.
and I'm sure rent is probably $1,200 a month on that house, right? So
Yeah.
there's a lot of factors that are to our favor on that deal. But the only thing I would have done differently for Kevin is I wouldn't have wrote a 75% first. I would have wrote it a lot more. I would have taken a lot more higher of a second note to put that first lien in a better, more favorable position to sell. Because here's the other factor with that, okay, is that it's only a $70,000 property. So the cost of foreclosure to get something back doesn't make a difference if it's $70,000 or $270,000. So when you only have a small portion of value between the value of the property and what you paid for it, there's still a fixed cost associated with it. So you want to make sure that the seller, the note buyer, in the event of a default, has enough room to make sure that he can cure that debt. Okay. So 6,000 isn't I don't have a problem with the 6,000 as much as I say I would probably wrote that as more in the 60, 65, because there's plenty of room in there to do that. So let's see, a couple more questions. Was there anything else on here, Eric? Let's see here. I don't. You qualify other people from the list, then go find them home. Yeah, so that's sort of an interesting. So Stacy asked, hey, we used to do this, and we may start looking back into this where we go find the buyers first, and then we go find the home. But when it's a seller's market, just go find the home. The buyers are there, just like Kevin just did. Kevin had 300 people inquire on one house. You don't need to go do it the other way. Now, what you might want to do, and you can try it, is now with these 300 buyers, Kevin, for example, find the 10 or 15 that are really good buyers and go back to them and go, if you're still looking for a home, I have other houses in the area. How much cash do you have available for down payment? And see who the ones that have the money, right? It's not, if you get a bunch of $5,000, I would probably pass on those, but you're going to have people that have 10, 15, 20, $50,000 down, and you can use those and you sort of pre-qualify them, and then you go find them a house, and then you sort of back into it, AKA that Orlando house, right? Think about that. If you already had a buyers and you know it, then you just reverse the deal structure. So let's see here. I think there's one more question here, and then I'm going to jump over. Okay. I think that's it. So, Jonathan, if you're still there, let's get to your question, because I know you said you got to roll. So, Jonathan, what do you got, man?
Hey, so one thing I was asking, maybe you touched on this already too, like, I feel like the neighborhood grade is also fairly important for the buyers, right? So selecting in like more family friendly, or does that matter at all? Is it just deal math only, or what's your thoughts on that?
I mean, people have been living in that house for 50 years, 100 years, wherever it's been, right?
Mhm.
So it may be the only place that somebody can afford and can actually live. So we got to take that into consideration. But there again, I'm going to look at it more from the exit side of it, right? I'm not owning the property, but I do own the note, and I'm more concerned about the buyer and their ability to pay, right? And if I'm going to sell the first and keep the second, I need to take that into consideration for whoever's going to buy that note as well. So the ZHVI, or the median home price, I want to make sure that I know what it is. Is it a factor of me doing the deal? No, but it's because I did 800 houses before I even knew what ZHVI was, and I did just fine. So I don't know that there's any it's just a piece of information. It's a clue, right? You're putting all these clues together, and you're going to try to take all the data that you have and all the facts to make the best informed decision on whatever it is to do. Because if you only have one clue or one fact and you're asked to make a decision, then you don't know if there's other data points that you're missing, if it would
Got it.
change your position on it. Make sense?
Yep. Okay.
That's why we collect all this stuff. That's why we look at rent value. That's why we look at ZHVI. That's why we look at ARV. That's why we look at a bunch of other factors so we can make the best business decision we possibly can based on the time and the property and the location. And then that's all you can do. And then doing that, there's still no guarantee that it's there. But I like working in the 90 or 95% confidence interval than I do in a 20%. Right? We're just
Yeah.
trying to increase the confidence interval of our ability to make the right decision. Because if you're in that 90% confidence interval, that means if you do 100 deals, 90 of them you got them right, and 10 of them you may have messed up, got them wrong, but you did so many of them right, the net effect of it is still good. Okay, makes sense.
Yeah.
All right, cool.
Is that something that you, when you talk about confidence interval, that's like you look at all these data, you're like, you know what, I'm pretty confident. Is that what you?
Yeah, I mean, it's like, okay, the ARV is 300. I'm selling it at 270. I like my chances. The median
Sure.
home price is 350. I'm selling it at 270. The growth or the increase in value is 28% over the last year. Okay, even though I don't get benefit of that, that's a positive number. It's better than it being negative, right? Those are the factors.
Okay.
The number of buyers that want this property is like Kevin, 300 to one property for sale. Those are, I don't need to do any rehabs. It's already in the thing. It's a desirable, it's in a good city. It's in a good state. It's in a good zip code relative to everything's around it. All those factors are what I'm talking about. You'd have to have a lot of things go wrong, horribly wrong, for you to lose money on the deal. Then you have the model on top of that, when you plug in the numbers that give you the financial impact of the model, right? So all those other factors just are value points relative to the model. At the end of the day, the model still has to work financially, regardless
Sure.
of what the answers of all those questions are, right? So
Right.
those are just added, it's like this. It's like, I'm going to drive a car down the freeway. Okay. I'm also going to drive the car with my seatbelt on. My car also has airbags. I'm going to drive the car at 2:00 in the morning when there's nobody on the road. And instead of driving 90 miles an hour, I'm going to drive 10. Okay. Those are all lead me to believe my confidence is far greater. I'm going to get from point A to point B without getting hurt. Okay.
Right.
That's all that we're doing here. Now, and if I decide, well, I'm going to drive 100 miles an hour and I'm not going to wear my seatbelt, and I'm going to, hang out the door, I got a lot better chance of not being successful in that attempt. That's all that we're doing. We're just mitigating the risk
Sure.
by knowing more facts in what we're trying to do. Okay.
What does
All right,
constant close charge, real quick?
I don't even know. Kevin, Kevin, if you're still there, what would unmute yourself? I don't even know what their charges. We don't get any, there's no benefit. We just care about the process. Kevin, what do they charge you on the file?
You talking about to do the constant close? Or the
Yeah,
auto?
to do the close.
I think it's about, don't quote me, I think it's like 1,000.
$1,000. Okay.
Yeah, for the constant close.
Rochelle was on there before. I think it's probably in the vault somewhere. Here, the value, it's the trade-off of time is really the first priority is getting the shit done right. Okay. Because they've done it
Right.
thousands of times. You have not. Okay. That's number one. But two, it's the opportunity cost associated with the time, right? If you were to do this yourself, maybe it's 10 or 15 hours of your time to do it. And that's assuming that you could even figure out how to do it and get it right. So I look at it from the standpoint, well, if I don't have to do that, I can focus on just getting more deals because I
Right.
know I'm going to make more money. Look at the deal that Kevin just did. I mean, shoot, he can afford to pay $1,000 on this deal. And if he has an extra 10 hours, of time. And he does 10 deals like that. That's 100 hours. Kevin, how many deals can you go find in 100 if you had an extra 100 hours to go find more deals and you didn't have to focus on anything else?
Oh, yeah, a lot. So
A lot
if it's
more,
something that
more than the
the
cost
people
of
to
it.
consider, just go
100%.
ahead and do the constant close. Like I've tried dealing with the process before and it's a headache. It's
Dude, I'm
definitely a
telling you,
headache.
it's not worth it at the end of the day, but you're going to get more value on your note. And that's really the other side of it. So, all right. One last question here that somebody just put in here. Where did it go? Where did it go? Let's see here. Tracy said, do you focus on primary 3-2s for family versus 2-2s or 2-1s for single? Here's what I want to buy. I want to be doing deals that people want to live in, right? You know, I think it's really market specific. I don't do a lot of townhomes.
Like townhouses and condos with HOAs and stuff. Our borrowers want single family homes. That's what
They want home ownership. They want that. Now, if I'm in Florida or something, maybe that's what the market bears down in Florida, right? I don't know. You know, I want to put myself in the best position to succeed. And the way I do that is by providing something of value to the masses, not into a specific market, right? So I personally like 3 bedrooms, 1 bath, you know, for a long time. Here's the other thing that we want to take into consideration. As it shifts to a buyer's market, what we're going to see is hedge funds will continue to buy. But what will happen is that they'll shift what they buy. So back when hedge funds first got started, before they got into a situation where they couldn't find the inventory, they prefer 3 bedrooms, 2 baths with the garage, 1985 or newer. Okay, let's just say that's their avatar. Well, now they can go back to that where before they had to say if they want the deal flow, they had to buy stuff that was older than that. So if we know that's the line in the sand, guess what? I don't buy if I don't have to. 3 bedrooms, 2 baths with 2-car garage, 1985 or newer, because then I got to compete with the hedge funds. We're not going to successfully compete against hedge funds because they have more patient capital and it's cheaper, and they're not in it to necessarily make a profit now. They have patient capital. They can wait a little longer. So,
I mean, our model is you buy it, you close on it, you get some cash now, and you get monthly cash flow the following month. Like it's pretty solid.
yeah. So Marie asked the question, how long should we hold a note to ensure that our note buyer, it's a performing note? So the definition, when note buyers look at notes, okay, it's either performing, non-performing, or reperforming. Okay. So the definition of non-performing is, for most note buyers, note buyers, funds, banks, is 2 consecutive months without payment. That deems it as non-performing. Okay. So they didn't make a payment in June. They don't make a payment in July. Then they don't make the payment come August, then it's deemed non-performing. So the inverse or the reverse of that, or to answer the question, then if it's not non-performing, then it must be performing. So we want to try to sell these notes as soon as we get them, so they don't turn into non-performing, because the upside gain by holding it is way less than the downside risk by selling it as a performing note. So we're getting performing value, but we're giving up a little bit of the discount because it's unseasoned. Okay. That's why the borrower underwriting file is so critical in having that stacked file, so that a note buyer can make the assessment based on what they see on whether or not how the borrower will perform or not. That's why there's a discount. That's why we're in that 88 to 92%, because it isn't performing. Now, the flip side of that, if you were to hold that note and it did perform, and you could get 9 months to a year out of it, you would be selling that note for much higher than the 88 to 92%. You might be able to get 95% for it. But the question becomes, A, do you have that kind of time to wait 9 months to get your capital stack back out and do it? Number one. And number two, can you afford for that note not to perform? Okay. And take even less money than you would have by selling it right up front. That's the question. So that's why I always take the money and run. I want to sell that note, that first note, as soon as possible, relieve myself of my debt and move on. That's assuming that I have either cash, private money, or hard money to take it down. So I hope that that answers the question. What would you suggest the minimum spread to be between the purchase price and owner finance? Make the model work? I don't know, plug it into the model. The model tells you the answer to that, right? How much cash now do you want? How much cash flow? How much cash later? And then you just back into it and you solve for the price. We've done that before. If you missed the call last week when we broke down the model in detail and we manipulated and changed some of those numbers after we assess value, that's exactly what the model does. You set what you want it to be, and then that will determine what you should be offering and buying that property for. Okay. Let's see here. On the note that we write, can you please tell us what the top 5 or 10 points that would be included to protect us? It's called using the transaction coordinator that underwrite and help you close the deal. That's the answer. Okay. Because there's too many other variables that go into it. I think Susan asked that question. I know exactly what I should be putting in there, but guess who doesn't do all that? Me. I don't have any desire to do it. And because that's why attorneys and servicers and RMLOs and everybody else in the process gets paid. And they're the specialists in doing it. And I want to go do one more deal. That's how that is. So let's see. I think a lot of our buyers to take 2-bed, 1-bed, convert them 3-bed, 2-bed. Maybe, yeah, that happens too. They surely can. But that doesn't really have any. The problem with that is that's a forced appreciation model, and you don't get that value when you sell it, right?
You get the security if they do it though.
Yeah, that it gives you a better investment, the value if they do it, but you wouldn't model it that way. You wouldn't model it with the assumption they were going to do that. You need to model it based on
If we sell a house we sell, this will be it, but the grandma's house, they take grandma's house, that's a 2-1, and go put granite countertops, new flooring, and convert the carport into a bedroom and add a bath. I mean, our investment to value, I mean, the default ratio on that model is, and it happens a lot, like it happens a lot where you go buy these properties because of the type of borrower we're looking for, and they add value and they go from there. And I think there's going to be a lot more of that in the market when, as we see a change in the market, people start getting older and people are going to start, cohabitating again, parents and stuff like that. So that's it.
All right.
I think
I think that's it for today.
Yep.
I'm traveling next week. I think Eric has some conflicts. I'm not sure that we'll actually do office hours live unless something comes up. But we may, we'll just check the Facebook group. We send out the emails, stuff like that. So we may be taking next week off. I don't know that for a fact yet, but hopefully that is, probably went a little bit longer today to cover that up. Hopefully this was of value. You missed anything, came in late, it's always in the Facebook group. Go back and check it out. And hopefully you guys got value on it, and we'll see you, especially on our two-day workshop where we're going to break this stuff down even deeper and really help to come up with a strategy on how to build your business with limited risk and accomplish exactly what you guys are looking for. So have a good weekend, and we'll see you guys on the next call.
See you guys. Thanks for
All right,
coming.
take care.
Later. Bye.